All right, Mr. Doherty, we're going to get into dollar cost averaging. You're going to explain what dollar cost averaging is, and then we're going to go through this little example set that you have. So are you ready to do that, Mr. Doherty, sir?
Absolutely. So dollar cost averaging is the practice of investing a fixed dollar amount on a regular basis, regardless of the share price. It is a good way to develop a disciplined investing habit, be more efficient in how you invest, and potentially lower your stress level as well as your costs. So, for example, let's say you invest $100 every month. When the market is up, your $100 will buy fewer shares, but when the market is down, your money will buy more. Over time, this strategy could lower your average cost per share as compared to what you would have paid if you bought all of your shares at once when they were more expensive than the average. Okay, so now I'm going to present an example. So, how dollar cost averaging works. So let's just say, for example, at month one, and this could be, let's say, January of the 2022 upcoming, you've identified a stock that you're very interested in, and you think it's a good long-term perspective. But you want to best take advantage of the market fluctuations. So what you would do, maybe sometime during the month, you might pay yourself first and take $100 off your paycheck and invest $100 into this stock or ETF, and let's just say it's currently trading at $5 a share. 100 divided by 5 will give you 20 shares. And let's just say that's the average price over that month. Okay, say the next month, in February, again, you're paying yourself first. You take $100 off your paycheck. You buy the stock at $5 on the average. So you keep investing little bits at a time every month as time goes on in the same ETF or stock. So this represents that the adage of dollar cost averaging, that you're buying more shares when the price goes down, and you're buying fewer shares as the price goes higher, thereby lowering your average over time and being able to enhance your realized and unrealized capital gains. Your total invested after that 5-month period is $500. The average share price, cost per share, is $3.70, and as a result, you have purchased 135 shares.
Yeah, that's pretty cool, Patrick, because oftentimes with newer investors, what they'll do is they'll look at some of the strategies that we taught. They'll look at the exponential 200-day moving average.
Yes.
They will look at the Bollinger Bands and say, okay, this is a great entry point. And then once they look at the Bollinger Band and say that's a great entry point, they'll just go all in with the whole $500. And
Right.
if they would have went in with a whole $500, then they would have bought at like $5 a share and would have got less shares at a worse price. But what you really should do, always, even if you feel super confident, you should at a minimum go in at 50%. At let's say at a maximum, I would say
Maximum.
50%. But best practices would say put up a third or a quarter, because even though you're at the bottom of the Bollinger Band when you purchase, and that's what we recommend, some people use price channels. Maybe we'll talk that on a different show. The price of the stock can continue to go down. And so you really want to protect yourself in those situations, right? So what do you have to say about that, Patrick?
Yes, well, again, that's the magic of dollar cost averaging, because again, you can't really time the market. It's very, very difficult to do so. And when you're, you want to, as Jim Cramer would say, do not buy all at once. Even if you are really confident that the stock is going to go higher. So what you want to do is, again, just if it's a stock that you really like or an ETF, just buy a little bit. As it comes down, you buy more. It comes down, you buy more. It comes down, and then as it goes higher, then you'll be able to realize, supersize the capital gains, realize your unrealized.
Exactly. So so best practices: never put it all up. I was in Virginia, and I was talking big on Disney. And my younger brother, he was there, and he had some money that he had, kind of had an investment in real estate, had extra significant amount of money, and he wanted to go in on a Disney trade that I went in on back in November, and he was going to put it all up. And I was like, no. Even though we're at the bottom of the Bollinger Band and it looks great, no. Best practices, if you're really that bullish, meaning you believe the stock is going to go up, then put up half, but don't put all of it up. So he put up half, but you can't be greedy in this game, Patrick. You know what I'm saying?
Yes. Okay, so here's this continued example. However, this is without dollar cost averaging. So let's just say this, our investor, is feeling super confident about this stock or ETF that we were just discussing, and he's saying, okay, I have $500. I'm just going to put the whole thing in. His average price is $5 a share, and he only has 100 shares.
Versus 135. Yeah, go ahead. I'm sorry.
Yeah, so let me go right here. So this is the result of dollar cost averaging in this example, in our example. So 500 shares, average price, $500, average price $3.70, 135 shares. Dollar cost averaging.
That's powerful.
Go here without dollar cost averaging, lump sum invested. $500, same $500, average $5, but there's a whole $1.30 more. So that's roughly 30% more. And then you only have 100 shares as opposed to 135 shares.
Yeah.
So in this case, dollar cost averaging is definitely an advantage.
Okay.
So now that we've gone through that example, to me the key takeaways are in the benefits of dollar cost averaging is that it establishes good investing habits. So essentially,